Fitch downgraded the U.S. credit rating last week to AA plus from AAA, citing debt concerns, volatility, and governance as well. Was this a right call from the agency? We spoke to Mohamed El-Erian, Allianz Chief Economic Advisor. He joined us last week to discuss the downgrade.
What Fitch put in their statement has been true for a while. So why now? And that explains the reaction that I and many others have had, which is first, this is surprising. Second, when you look at the reason, you scratch your head as to the timing of this. And then thirdly, which is most important for our audience, is the expectation that this will have minimal impact on the things that are sensitive to ratings.
And indeed, even though we did see bond yields rise to some degree in the wake of that, they've come back down a bit. Let's get another view on this downgrade in the U.S. economy more broadly. Joining us is Kenneth Rogoff, Harvard University Chair of International Economics and former Chief Economist at the International Monetary Fund. Ken, it's great to see you. And it's interesting how Mohamed framed it as, even though some of these issues are around, we've known about them. So it's interesting that it is happening now. It does seem to come down to this sort of political maneuvering that we see in Washington that could hurt the fiscal position of the United States. How urgent do you think an issue that is?
Well, I think the reason Fitch did this was simply to, think ahead maybe 15 or 20 years. If there's some kind of bizarre problem, where were they? Did they say anything about it? On the timing, as Mohamed El-Erian, I think, makes a lot of good points. It's pretty clear Trump's up and up in the polls. The possibility that he might be president has materially risen, and the possibility that there's a very divided president, the president's one party, the House and Senate are another party, in a very fractured system. There's a level of dysfunction. Who can deny this? So they're making a statement. I think the thing that's difficult to sort of reconcile is if the U.S. runs into trouble, so does everybody else. So if you think the U.S. should get downgraded because they're going to spark an international crisis, you kind of have to do that for everyone else. It's not a statement about what they think the interest rate should be necessarily, so much as making sure that they set it. That said, certainly the possibility that we have higher inflation in the future, I don't think is fully factored into markets. I don't know that that's what that downgrade represents. But certainly there's higher chance of that than there was 5 years ago.
And just to kind of add on to that, are there other international economies that you foresee Fitch having to re-rate after this U.S. re-rating?
Well, what I'm really trying to say is if you're going to call the U.S. Downgrade the U.S., you're kind of having to change the whole grading system because everybody runs into trouble if the U.S. is. That they're looking at the institutional problems in the U.S. And I think they're undeniable. You have to have your head in the sand not to think that there's an issue. What it will lead to, I don't know. Usually when the U.S. has a problem, it's even worse for everybody else.
Well, it's worse for everybody else, which is sort of has helped solve the problem for the U.S. up until now. In other words, if it's the least dirty shirt or whatever analogy you want to use that people have used for the United States, that has sort of safeguarded its status reserve currency as safe haven in terms of Treasuries. What would change that?
Oh, I don't know that there's anything going to change that overnight. But I think we have to distinguish between general problems that hit the world, like the pandemic, when the U.S. is a safe haven, and things like the financial crisis in the U.S., creates some kind of artificial, and it would be completely artificial, debt crisis, which is also a world shock. That doesn't necessarily lead to an appreciation of the dollar the way a pandemic might.
And so even with this downgrade that has rattled markets clearly, is there any more clarity around where the economy actually is sitting with regard to the analogy that we have used for now the better part of a year and change of a soft landing versus a hard landing or any other type of landing that could take place as induced by or as a result of Fed policy?
Well, what I think I've been saying for the last year and a half is we're not going to see a hard landing or a soft landing because there's not going to be a complete landing. I think inflation is going to stay elevated for quite a while. If the Fed wanted to have a landing, it would be a hard landing. But I don't think they want to have that. And so they're going to just be quote unquote patient. So I think those two analogies are missing what's actually happening.
And so are we just in a sort of elevated inflation environment, but also, I guess the silver lining of that is that it's accompanied by some level of growth?
Well, there's no question the economy's been better than anybody thought, and particularly point to labor markets. I think it's less easy to know what's going on with the real economy because the gross national income and the gross domestic product are kind of saying different things. I tend to think the productivity's down quite a bit. The economy's growing in the sense that they're jobs, but not necessarily otherwise. But yes, things are better. If the Fed, it's been remarkable that interest rates have been raised this much. I would say we're in the 90th percentile of outcomes that could have happened here. It definitely could have been, maybe was likely to have been worse, as many people had said. But on the other hand, inflation's not all the way down. And at some point, the Fed has to really look in the mirror and decide how quickly it wants to do it. And of course, the downside of waiting too long is that inflation expectations have remained remarkably stable. I think they have moved up a bit. There's more of a spread in inflation expectations. They're not exactly solid as a rock, but they've stayed stable considering what's happened. And considering what's going on with fiscal policy, the need for defense spending, green transition, et cetera. So far, things have been stable. And I think the trade-off here for the Fed is, can they take a couple more years, maybe even 3 or 4 more years to bring it down to 2%, or is that taking too big a risk?
So what is the kind of larger driving forces around an elevated inflation environment for longer that's still above the Fed target? I mean, is it shelter costs? Is it everybody buying tickets to go see Beyonce and Taylor Swift? From your purview, what are the largest contributors to that?
Well, I think there are a lot of fundamentals that have turned against the economy. So defense spending is clearly going to go up a lot. Look at what happened with the Russian and Chinese ships coming to our near our shores and are not having a big fleet to send up against them. Look at what's going on in Europe and the Taiwan Straits, the green transition. We have not begun to pay for that, much less what needs to be done for developing economies. Populism, whether it's a Republican president or a Democratic president, is going to redistribute income. That's good, but that's going to also lead to greater spending, more price increases. And I think actually the list could go on quite a ways. Deglobalization, no question about it. That the era of peak China has come and gone, and that was also making it easier to keep prices low. So not the end of the world, but I think there were a lot of factors which made it easier and even pressed all central banks to be able to bring down inflation. And I think it's over. I think we're at a turning point where we'll see higher inflation, not just in the US, but everywhere. Not galloping inflation, but where inflation had been shaded well below 2%, I think in many places it'll be shaded well above 2%.
And it sounds like, if I'm reading between the lines here, Ken, what you're saying is that it's worth it. In other words, that the things you are getting for that higher inflation, the things you listed, for example, are by and large positive things for society and the economy, no?
Well, the things that are happening in the world that I just listed of needing to pay for the green transition, that's just a dead weight cost, no matter how you want to portray it. It's a good thing. I favor it, but it's not a growth strategy. It's something you need to do. Things like defense spending, those are negative things. Redistribution is probably a good thing. Where I think think the Fed is wise to be slow is there's a trade-off. We could have inflation at 3 or 3.5% instead of 2%. Not good, but not as bad as having a deep recession. So Americans are complaining about inflation, but believe me, if we had another deep recession, it would be 10 times worse. And of course, everyone would blame it on the Fed.
Ken, lastly, while we have you, I want to ask you about something quite different, because while most people know you as an economist, some won't be aware that you are also a chess grandmaster, and you have been since 1974 when you earned that title. There is a link between chess and one of the big themes that we've talked a lot about every day, although we haven't talked about it yet, and that is artificial intelligence. AlphaZero was, for many, one of the original big AI breakthroughs back in 2017. It was a computer program developed by AI research company DeepMind to master the game of chess. I'm sure you're familiar with that. So I'm curious about your take on AI, both as it relates to chess, but also as it relates to our lives right now.
Well, first, as it relates to chess, I mean, chess has been at the center of artificial intelligence research since the 60s and 70s. And I knew Richard Greenblatt, who was a pioneer at MIT in the 70s, played his program, Ken Thompson, who's now at Google. And this was one of the most popular events at any AI conference for a very long time. Indeed, as you say, the DeepMind program, which eventually Google bought, was a phenomenal breakthrough. And what's been interesting, I think, to chess players is it just keeps getting better. They thought computers were gods in 2000, and then the DeepMind came along and it was even better. So the rate of improvement is phenomenal. I'll also say that it turns out hasn't been bad for chess. It's actually made it more interesting so far. I hope there are other aspects of our lives which are true, but I think, having seen how fast it evolves in chess, and it's not once. I think with ChatGPT, we've just seen the beginning. I think in 5 years, you won't even recognize how phenomenal it will be. So yes, this has been a long time coming. I've speculated about it for a long time based on chess. And I think we're finally at the dawn of this. I don't want to sound evangelical because I don't know which way it's going to go. But yes, if you look at the experience of chess, faster than you think and for longer than you think, but also not necessarily as detrimental as you might think. Humans have adjusted, and it's been very good.
Well, can you elaborate on that a little bit? You said it's made chess more interesting. How?
Well, first of all, people had thought a lot of positions were boring, that the computer shows, well, try me at this position. And it turns out to be just well springs of creativity, positions where the best player in the world, Bobby Fischer, I think would have maybe even given me a draw back in 1975. Now is the beginning of the game for many players. So this depth of learning, players venture much more complicated and interesting positions because they have other ways to explore them. So surprisingly, we thought it would lead to more draws, right? If you figure it out better, you're going to get more draws. Not at all. So here's this simple compared to human intelligence game, which you would think you would solve out. And yet you find these layers of interest. I think we'll see this in art and many, many things. I don't want to get into the whole socioeconomic ramifications, but I think chess has been the cutting edge and will continue. It gives a hint at what we're going to see with other things.
Kenneth, really fascinating. Thanks so much for taking the time here with us today. Kenneth Rogoff, Harvard University Chair of International Economics and former Chief Economist at the IMF. Thanks so much.
Thank you.